Okay, good morning and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and today we're here to talk a little bit about where the markets currently sit. Not a lot has changed here over the past couple of weeks, but we continue to see a lot of complacency in the markets. So today we're going to discuss what that means and how we are positioning for that market session the market outlook that we currently have here. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is a solicitation or recommendation to buy or sell any specific securities. So we'll start off with our normal market update just to show you where the broader markets are currently sitting, as well as where emerging markets sit. And we'll take a look at some of the metrics to just gauge where the current market is currently sitting, because we are at some extreme levels. We see quite a bit of complacency at extreme levels. So we want to make sure that investors are aware of what these metrics mean and how to position for that in your portfolios. We'll take a look at rates and specifically how the fixed income markets currently are moving in conjunction with the equity markets. We'll take a look at commodities. And then from an economics perspective, I want to hone in on some manufacturing and services PMI data that we've just received, what that's currently pointing in terms of the shape of the recovery. Take a look at the housing data in terms of, because that also informs some of our views in specific stocks, and then take a look at a few ideas that we have. And if we have a few minutes here at the end, we'll open this up for Q&A. But the primary question that we want to help investors answer right now is really, how does further stimulus impact the equity and fixed income markets? That is largely what we've been trying to answer here for the past couple of weeks. We're starting to see some shifts here in both equities and fixed income as a result of the talks of further stimulus, especially as we look towards that March timeline. We're trying to see how equity markets are responding, so that's what we want to show you. This is Tony Zhang. I'm the chief strategist here at OptionsPlay. And what I want to show you are my charts, my technical research, my economic research, and how I'm informing the decisions here in the broader markets as a result of that. So when we look at the broader markets, the first word that comes to mind is really complacency. And what I mean by that is that the equity markets that we're currently in, the left-hand side is a weekly chart, looks very similar to the equity markets that we saw going into the coronavirus sell-off here. A lot of complacency, week after week of just slow grinding moves higher without any real significant pullbacks here of more than just 1 or 2%. Most pullbacks that we see are mostly intraday and followed by quickly continuation higher. Yesterday, we saw similar type price action at the open. Markets were stable, sold off pretty heavily by about 10:30 a.m. And then by 11:30, markets have recovered already from that sell-off here. So this is really the type of complacency that we continue to see from markets, where market participants continue to buy every single possible dip, regardless of how small those dips are. And the longer this goes on for, the higher the probability you get a more violent pullback here in the broader markets. Now, when does that violent pullback materialize? That's what's almost impossible to predict, but it's also important to look at those warning signs and start thinking about how do you position your portfolio for that potential pullback here. The reality is you can't really time it. So a lot of investors that try to go out there and buy puts now could end up losing quite a bit of money on puts that could, where the pullback doesn't materialize for a few weeks or potentially even a few months. So this is really where going out there and buying puts is not necessarily the best strategy. What we prefer, especially in a higher volatility environment, this type of trading environment, is number one, still remain cautiously bullish because the trends here are very clear, moving upwards here on both the daily and weekly chart. Momentum still remains positive on both the daily and weekly chart, and money flow remains positive on both the daily and weekly charts. So what that means is that we still maintain a cautiously bullish view here in the broader markets, but as the further extremes that we move to in terms of complacency, the more we lighten up our long positions, the more we focus on yield collection, so selling cover calls, especially when markets are near all-time highs. Selling cover calls collect premium because these types of violent pullbacks, they tend to appear fairly quickly, and they happen fairly out of nowhere seemingly sometimes. They happen very quickly. So in order to protect your portfolio during those downturns, one of the most effective strategies, or one of the only strategies to protect your portfolio in those scenarios, is to buy puts. But if you wait for an actual correction to materialize to buy puts, they will be very expensive. So how do you pay for those puts? You pay for them by generating premium right now by selling cover calls when elevated implied volatilities are still pretty high. You want to sell cover calls right now, collect premium on the stocks that you own, so that if and when that pullback starts to materialize, you have already collected some premium to pay for those puts. But you don't want to buy puts early, because you could have been buying puts here when markets were complacent. You could have bought puts here when markets were complacent. You could have bought here puts when markets were complacent. And in that whole time, you would have just been leaking time decay and losing money on time decay as equity markets continue to move higher and continue to grind higher. You're losing both on delta and theta. So this is really why it's not a good idea. Just because you see this complacency, even if you feel that equity markets are going to pull back, that why buying puts in anticipation of a pullback many times is not a profitable strategy. Now, when we look at the Qs, the NASDAQ 100 index, we see basically the exact same price action here, and very similar price action. Both money flow on both the weekly and daily charts are still positive. Momentum is still positive, even though approaching overbought. They're not at extreme levels here. But we have seen multiple months of complacency where pullbacks to just the 21-day moving average have been buying opportunities. The NASDAQ 100 near all-time highs. Microsoft just reported earnings and is now moving higher here. So we have some tech stocks starting to break out higher here. So this is really one of the things to pay attention to, especially as small caps continue a very strong move here to the upside. I don't recall the last time I've seen this kind of continued strength from small caps here. A lot of investors asking, are we getting this rotation into value out of growth here? And this is really where, we have to look at the charts, and there seems to be some slowdown of the outperformance of growth versus value. But so far, the two are very hand in hand. So meaning value or small caps keeping up with the mega cap tech names. This is something that we haven't seen in a long time. So this is a chart of value versus growth here. And over the past 6 months or so, we've effectively seen a segment of the market, value, underperform growth for a long time, but over the last 6 months, start to form this bottom here of value versus growth. And the question was whether or not we were going to get a breakout here higher and start to see value outperform growth. So far, we have not seen that materialize just yet. This on the right-hand side is a zoomed in chart of this, what we see here on the left-hand side. And as you can see, last week we pointed this out, this potential breakout here, but so far that has failed. So this inverted head and shoulders that could signal a bottom here and a breakout here so far has not materialized. And the question is whether or not this will simply just continue. This could very well end up just being a consolidation or continuation pattern here. So you basically have a bit of a pause here from this, let's just call it underperformance of value. And then what you could see is a breakout here, and you can continue to see value to underperform growth. That is still possible. Right now, we are still in this range. We don't have a breakout here. Once we have a breakout, we will inform you once again. But so far, we have not seen this breakout materialize where value starts to outperform growth. When we look at the RSP, which is the S&P 500 equal weight index, this also has started to underperform here a bit over the past couple of weeks. So what we're starting to see is that the rally we're seeing in the S&P 500 is starting to narrow, meaning it's starting to become fewer and fewer names that are moving the markets higher while the broader markets are being left behind. Versus over the past few months, it's been the opposite. We've seen a broadening out of the rally where the big tech names haven't moved a whole lot, while a lot of the smaller names in the S&P 500, the smaller weights in the S&P 500 started to rise, catching up, if you will, with the equity markets. So when we start to see equity markets outperform only with the big tech names, that also is some concerns that we have that also point to a potential market top or starting to approach a market top, especially, and I don't necessarily want to throw out the word bubble, because I do think that the stocks that have reached what we classically would contain bubble status are relatively small, relatively fewer names that are in that particular category. It's not like the dot-com boom where the vast majority of stocks were kind of in that classification, but we certainly see quite a few names in that category right now. But smaller names, especially the names that have gone IPO, that are just trading at what we would consider eye-watering valuations where the growth of those companies can by no means keep up with the growth expectations that the markets are currently pricing in. So we're seeing some froth here in the markets. We haven't seen what I would consider the euphoric stage of the last stage that you see before a market crash, but we're starting to see some of these warning signs. It's important to understand with these warning signs, how do you position for them? Another metric, and this is just to show you the different things that we're looking at to gain this view in the broader markets, is really the extreme complacency that we see here. The 20-day put call ratio has reached a new extreme here at just about a little under 40% of all options that are traded are only puts. Normally this is somewhere in the 70 to 100% range of all options traded were puts. Now only about a little over 40% of options that are traded are puts, meaning far more call buying and very little put buying. This type of extreme also is generally used as a contrarian indicator to signal we're nearing a market top. Now, the fallacy with this signal, with this this complacency or contrarian indicator, is that markets have basically been at extremes since July. So we've been at extremes in terms of, this is the 20-week put call ratio. This is on the left-hand side. This is the 20-day put call ratio. And as you can see, we've been reaching new extreme levels for a long period of time. So markets can remain stretched or remain at extremes for long periods of time. And this is, again, why none of these indicators in itself is a good signal to go out there and buy puts. A lot of investors sometimes, first time they see some of these types of indicators, they say, oh, these things are extremes, let me go out there and buy puts. What you have to recognize is the fact that they've already been at extremes for months on end, but we haven't seen the actual correction materialize yet. You need some other catalyst to generate that type of correction. Whether that's, perhaps the stimulus bill falling short, there could be a variety of things. You could have another strain of the pandemic, a strain of the coronavirus that causes mass lockdowns. Those are the types of catalysts that could potentially drive a market sell-off here. But these are just warning signals that if you do get a catalyst, that you could get those type of very violent, very quick pullbacks of that 10–15% pullback to materialize in just over a week or two, rather than, a more slow, a more, I would say, orderly pullback here, if you will. So looking at yields here, we've definitely seen a bit of decline here in yields here, as perhaps over the past couple of weeks, some of the market expectation of a big stimulus bill, another $1.9 trillion stimulus bill, is pared back a little. I think investors are now thinking that, $1.9 trillion is unlikely, that it does seem that there is a bit of back and forth between Democrats and Republicans working together to try to pass a bill that is supportive of the economy, but maybe not at that type of size. So we have seen Treasury markets pull back here a little bit away from the extremes of approaching 120 basis points back to 105 basis points. In my opinion, I think Treasury yields are more I would say reasonably priced at these levels, just slightly above 100 basis points or around 100 basis points. And especially given the Fed has continued to commit to buying these treasuries long term, especially even though they haven't moved this far out of the curve to the 10-year yields, 10-year bonds just yet, we do anticipate that they will. So I think that's going to put an artificial cap, in my opinion, as to how much higher 10-year yields can go. So right now here in this 100, 110 range, I think this is a suitable range here for where treasuries are going to sit. So, that allows us to get a better sense for, the dollar index. So for trading dollar, we've also seen the dollar moderate a little bit here into this 89, 91 level here. So this really, in my opinion, is more of I would say a reasonable place for the dollar to be trading at least for now, until we get a little bit more clarity. I think that if the stimulus bill gets closer to 1.9 trillion, we're going to see more sell-off. If, let's say, that stimulus bill is significantly smaller than 1.9 trillion, we might see a rally here in the dollar. But right now, dollar is kind of in this equilibrium right now, expecting the stimulus, but expecting a slightly more pared back version from the 1.9 trillion that's we're currently looking at. And we're seeing treasury markets or fixed income markets react to this. We have seen some pretty significant moves here in the TLT. So a bit more of a flight to safety here, a bit more of investors buying safer government bonds, and at the same time, selling off a little bit of the investment grade, the riskier bonds here. So this is starting to see a little bit of shifting from the fixed income markets, perhaps, looking at some of the complacency things that we're seeing in equity markets. We're starting to see perhaps some positioning, perhaps a little selling of profit taking in equities, starting to position in more safer assets like treasuries, a little slightly out of LQD and HYG, the more riskier bonds. So we're certainly seeing some positioning shifting here in equity markets as they continue to approach these all-time highs and more complacent levels. So looking at some economic data here, this is really where we continue to see some interesting surprises here to the upside. Manufacturing PMI came in substantially higher than the survey at 59.1 versus a survey of 56.1, and also services coming in slightly better than expected at 57 versus expected of 53. So what this is showing us here is, manufacturing has been what's driving a lot of the economic gains that we've seen in terms of recovery, but services has been falling behind, especially with continued limited lockdowns around the country, limits to indoor dining and indoor related activities. Services has really been much slower to recover. And that's why we've seen such a strong V-shaped rally here in manufacturing, versus services is really moderated here towards the second half of 2020. But as we can see towards the end of the last year, we're starting to see some movement here to the upside. Some movement here to the upside for services is, in my opinion, strong for the economic recovery. And this is partially why we are likely continuing to see equity markets not sell off, because the economic recovery is continuing to take shape. But there's no doubt that we are near extreme levels, we're near extreme complacency levels, we're near extreme valuations, and these are always going to weigh on investors' mindsets. So profit taking, selling cover calls, those are the types of strategies that are optimal at the current moment. And then if we do get that pullback here, using those premiums to buy those puts. On the housing side, we saw an extremely strong end to the year in terms of existing home sales. And this is in the backdrop of home inventories reaching a new multi-decade low here. So we have never seen housing inventory levels that are this low. So this is really one of the reasons why we continue to like the home builders. There's clearly a strong demand here for housing, as the work from home concept is going to be a very permanent shift here away from office space. People are moving away from the cities. We're continuing to move from the cities as people realize that even in 2021, we're unlikely to go back to our offices. A lot of people are planning 2022 or potentially never returning back to the offices. So housing remains extremely strong. We expect it to continue to be strong in 2021. So those are some of the ideas we want to take a look at here today. So the first one I want to point out here is this. We talked about whether value is going to outperform growth here. And so far, as we saw on that previous chart, we have not seen that breakout level just yet. So we're starting to see these tech names, as I was showing you before, that the leadership in the S&P 500 and the Dow in the NASDAQ 100 is continuing to narrow. We're seeing fewer and fewer names lead the markets higher, and tech shares are actually on that front. Especially unprofitable tech stocks are the ones that are most that are gaining the most strength here. But Apple, what I do want to point out here is you've got this triple top here at 138, which corresponds with the September highs. And the last attempt at 138 was rejected, but we recently just got a breakout one day before the earnings announcement here for Apple. So this is really a nice setup here for potential continuation higher here, because you have this triple top. You've got this consolidation range, however you want to call this, a triangle, a wedge, whatever it is, but it's a nice consolidation range where you've gotten a breakout here. You've got strong relative strength going into the earnings event. And if you look at the Apple earnings event, I think there's quite a bit of potential bright spots to look forward to. You have both the services business, which I think most investors are currently paying attention to, that seems to be growing very nicely, especially during lockdowns. We think that services will remain a fairly strong revenue driver here for Apple, and a shift away from hardware towards services is why Apple is trading at a much higher valuation it is now than it was, let's say, 5 years ago, whereas predominantly trading at a much lower multiple. You have the new MacBook Pros, which I have talked about pretty heavily here in terms of the new MacBook laptops, which they recently moved off of Intel chips to extremely good reviews, and now puts all Apple devices, iPhone, iPad, and MacBook laptops, all in the same chip, all in the same ecosystem. You can run apps across all three devices. I think that's a game changer here for Apple in terms of creating that ecosystem that they've been building, and it really continues to develop their services business. So for those reasons, I like Apple, not only for this particular earnings cycle, but over the next few earnings cycles. And then you add on the few things that they've recently announced with augmented reality. We've been talking about VR and AR for quite a few years, and I think we're just now on the verge of potentially using some of those technologies, not just for play, but for work. Apple's developing AR glasses. They are also getting into the autonomous driving. That is a bit of a long shot here. I'm not sure how Apple's going to do in that particular front. We know they've been working on these types of things for quite a few years now, but they've recently made an announcement. So when you compound all of those things, I think investors have a lot of optimism going into this earnings announcement. So the breakout here we're seeing on Apple seems interesting here. A similar type chart pattern here with a completely different thesis is D.R. Horton. I like D.R. Horton because they are the largest single family home builder here in the US, with most of their exposure to metropolitan cities or just outside of metropolitan cities, which is where a lot of people are moving out of cities into the suburban area, single family homes. They focus more on starter homes, which tends to be the ones that people are buying as they move out of cities, away from apartments. So D.R. Horton on the verge of a breakout here of this $79, $78, let's just call it a triple top here, starting to see some relative strength out of this stock going into the earnings event. So both Apple and D.R. Horton, just to be clear, these are both earnings plays. They both report earnings this week, but a potential breakout prior to earnings, that relative strength going into what I believe are strong fundamental factors coupled with this technical breakout. Those are the types of plays that I like to look for going into an earnings event. So earnings event obviously has more risk. Make sure that you understand those risks before you go ahead and place a trade similar to this. And lastly, I'll talk a little bit about, as we showed you here, both the 10-year yields, the dollar index has started to moderate here a little bit. We've seen more of an inflow into higher yielding sectors. So we usually don't talk about sectors here during our ideas section, but XLU recently making a breakout here. XLU making a big move here to the upside, retracing about 60, for those of you that like fib levels, retracing about almost 2/3, 61%. And now we've gotten a breakout here. So from my perspective, we're seeing a lot of inflows into these higher yielding sectors. So XLU at the forefront of that, starting to break out higher here, especially as there's a flight to safety. There's a bit of defense being played right here. When you have higher yielding and a bit of defense, that's really where XLU utilities start to shine here a little bit, especially, XLU also has some of those renewable power names in there as well. Those are the ones that are doing very well within utilities. Those are the ones commanding very strong multiples here right now, especially with Joe Biden's infrastructure spend coming down the pipeline. So those are some of the ideas that we have here for the current market outlook here on Tuesday, January 26th. So far, equity markets are looking like they're going to open up just slightly higher here. Asia was a little bit lower. Equity markets here in the US are fairly stable here going into the open. Our expectation here is between this week and next week, big names reporting earnings. So pay attention to those. And the one bright spot we're starting to see is that big names that are beating earnings like GE are moving higher here. This is one of the things that have shifted a little bit this earnings season. Last earnings season, stocks that beat didn't really move much higher. Stocks that missed did move substantially lower here. We're starting to see stocks that beat start to move higher here. So this could be part of what continues or perpetuates this complacency that we continue to see markets for potentially another 2, 3, 4 weeks as earnings season continues to perhaps show some strong beats here to the upside and equity markets respond positively to that. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to how we're viewing the broader markets, as well as some specific ideas going into earnings season this particular week. So with that, thank you so much. I hope you guys have a great trading week, and I'll see you guys here next week for our next market outlook session, as well as an options education session on Wednesday. So with that, have a great day, and I'll see you guys next week.